Hi, I'm Michael Yardney. Last year was a great year for many property investors. In fact, I believe it's going to be one of those years where those who didn't get into the property market are going to look back with regret. Interestingly though, although many of us started 2014 with confidence, over the year our markets gave us a few reminders not to get too cocky. Overseas markets were turbulent and back home inflation rose, unemployment crept up, consumer confidence at the end of the year dropped like a stone. House prices peaked, or house price growth peaked mid-year. The prices didn't, because they actually kept growing, but more slowly in the second half of the year. And I think there's going to be slower market growth in 2015. In spite of all these things, though, I still see many reasons to be positive selectively about property this year, because our economy is going to put some stumbling blocks in front of us and it won't be all smooth sailing. But it never is. So today I'd like to whip around Australia to see how our markets performed last year and make some forecasts for 2015. Okay, what happened last year? Our market saw strong growth, with home values rising in every capital city, but of course Sydney, Melbourne and Brisbane, they were the standout markets. Australia's property markets were buoyed by strong population growth, historically low interest rates, a voracious appetite for capital growth by investors, and a desire by overseas investors to place their money in Australia's big capital cities. In fact, the year finished off with property investors taking out around 50% of all new loans, the highest percentage on record, and many investors had a great year. But now we're in a more mature stage of the property cycle. The property cycle bottomed in the middle of 2012, and since then the markets, especially in Sydney, Melbourne and Perth, rose strongly. But the big picture overview doesn't really show you how fragmented the markets are. Really, there are different markets in different states, different price points, in fact different types of property, and they're all behaving differently. Now, some of the factors that will affect 2015 will mean that it won't all be rosy. I see consumer confidence falling in the first half of this year. That's going to have a negative impact on our property markets. We'll keep hearing the world's problems overseas, about China's economy having issues, about the European economy being a basket case, about deflation in the world, all those things. And locally, I guess we're going to be worried about rising unemployment, a weak economy, and a government that can't deliver its budget. However, there are still heaps of positive factors that are going to underpin our property markets. These will include things like interest rates. They're likely to remain at historic lows throughout this year, and possibly we'll have another couple of falls in official interest rates. At the same time, banks are going to continuously aggressively chase new business, meaning more people are going to be able to enter our property markets. We're also going to have strong population growth in our capital cities, albeit at a lower rate than in previous years. According to the Australian Bureau of Statistics, currently Australia's population is growing by one person every 77 seconds. That's right, driven largely by international migration. This means our population is growing at around 400,000 people each year. Of course, many of those want to live in the same four big capital cities, and in particular Melbourne and Sydney, where many of the good jobs are, which means demand is going to outstrip supply in our middle and inner ring suburbs there. I think this year's also going to because we're going to feel they've missed out. Homeowners and investors are going to want to get in the market. They're going to want to get a foothold in the property ladder before prices increase too much further, or before borrowing conditions change. And I still think overseas investors are going to keep ploughing money into Australia, seeing it as a safe haven. The low Australian dollar is likely to keep encouraging overseas investors to put money into new and off-the-plan high-rise apartments in our capital cities. Unfortunately, this is happening at a time when we already have an oversupply of this type of property, and that's further going to inflate the price of inner CBD properties, but they're not going to be good investments. And this year I see the wealth effect kicking in when existing property owners, particularly in Sydney and Melbourne, are going to feel better off as the value of their homes have significantly increased over the last few years. Some will use this extra equity to move home or invest in real estate. And buying in self-managed super funds may accelerate in the first part of this year as the government contemplates removing the ability of super funds to borrow as recommended at the end of last year by the Murray system, financial inquiries. And I think as the year goes on, our economy is going to improve, consumer confidence is going to increase, but throughout the year our markets will be fragmented. Just looking back what happened last year, Sydney was a standout performer in 2014, with house prices now at record levels, and they're likely to continue climbing this year, albeit at a lower level. I see capital growth in the order of maybe 6-7% this year, for well-located properties. We had strong price growth in Sydney in 2013 and 14, but it started to slow down a little bit as the cycles are maturing more and interest rates are not pushing the market as much. I think we're going to have periods of ups and downs this year, but that's to be expected at this stage of the property cycle. But the strongly performing local economy and continued undersupply of housing will generate consistent buyer activity in Sydney, and that's going to mean it'll probably remain the best performer again in 2015. However, investors and home buyers are going to have to be much more selective when purchasing properties in 2015. Mistakes aren't going to be covered up by the amazing growth that happened over the last couple of years. Now, Melbourne was a strong performer last year, pretty surprising, but as always the markets were fragmented, and in the inner and southeastern and eastern suburbs, in the middle price brackets, they were the best performers. Of course, first home buyers remained out of the action a little bit, and there was increasing demand from owner-occupiers upgrading their homes, and the top-end properties, the prestige end of Melbourne, did pretty well last year. Investor and owner-occupier demand is likely to be a little bit slower in 2015, but I still think we're going to get 4 or 5% growth in Melbourne, with some segments of the market still best to avoid. Avoid those areas where there's a significant oversupply, like in the house and land packages in the outer suburbs and in the inner CBD area where there's too much new and off-the-plan properties. In the outer suburbs, new home buyers are avoiding the new properties and they're buying established properties that they can get considerably cheaper. In a CBD, avoid them because there's just too many happening at the moment that I think you could be better off buying established properties in Melbourne's southern or eastern suburbs and finding the sort of property to which you can add value through renovation. Now, last year Brisbane finally turned the corner and it did pretty well. Its unemployment rate fell, population growth increased, job seekers came from down south, and there was good perception that the buying opportunities were there compared to Melbourne and Sydney. However, it wasn't a spectacular performer that some commentators predicted. There was, though, a resurgence of property investor activity over the last year, with interest being particularly strong in the middle range, inner and middle ring suburbs. I'm expecting consistent growth in Brisbane again in 2015, particularly as more investors, owner-occupiers and foreign buyers look beyond Sydney to more affordable opportunities, meaning there's still lots of upside in the Brisbane property market. On the west coast of Australia, Perth recorded a significant slowdown over the last year, and there was flattening activity from buyers and investors. I think this means Perth properties are going to prices are going to remain flat throughout 2015. Even David Airy, the president of the Real Estate Institute of Western Australia, said Perth's heading for a downturn this year with an oversupply of properties for sale and fewer buyers on the market. Adelaide, the city of churches, its housing market has consistently underperformed since the beginning of 2008, in line with the underperforming economy. With the highest capital city unemployment rate and a weakening economy, capital growth is likely to remain similar this year in the order of 2 or 3%. Up north, the Darwin property market was hit by a slowdown in the mining sector and falling commodity prices. While it's been a strong performer over the last 10 years, that was fueled by investor sentiment. The excitement seems to be over now. It's what I'd call a shallow market. There's not a lot of market depth there. There's not a lot of volume there, and therefore prices can rapidly swing one way or another. I've always found investor-driven markets more volatile than our big capital cities, and that's why I avoid them. Prospects of price growth are low due to a wind down in major infrastructure there. Hobart's housing market finally picked up in 2014, but house prices remained low, growth remained low, and a relatively weak economy and negative population growth is going to limit further price growth. And finally, in Canberra, our housing markets also performed poorly, with most reporting bodies recording flat to modestly falling prices. Overall uncertainty with the federal government warning us of significant budgetary cuts led to job insecurity, especially in the public sector. And this is again likely to translate to subdued activity in the housing market in Canberra in 2015. So this year, I think the market's going to be different. Home buyers and investors are going to have to do much more careful due diligence. They just won't have the booming markets to cover up their mistakes. This means they're going to need to buy the right sort of property. In my mind, that's one with a level of scarcity, meaning it's going to be in continuous strong demand by owner-occupiers, because they're the ones that push up property values. And also, sure, we need tenants who are going to subsidise that mortgage. It's got to be in the right location, and that's one that's going to outperform the averages in the long term due to the demographics, the sort of people that are living in the area. It's going to be bought at the right time of the property cycle and for the right price. Then the trick's going to be to be able to finance it correctly, to hold it in the long term and reap the rewards. Now, if you want to know what I've been up to, what I'm buying, and I have been very actively buying what I'm going to buy, I'm going to explain this and what not to do at my upcoming property and economic market updates that I'm holding around Australia in March and April. You can find out all about this at the link under this video at propertymarketupdate.com.au. If you want to take advantage of the property markets in 2015 and not get caught by the traps ahead, please come along to our property market update one-day seminars in 5 states around Australia.